everyone. Welcome back to the course International Financial Management. In our previous lecture, we laid the foundation of exchange rate theory by studying the purchasing power parity or PPP. We understood how prices across countries, when expressed in a common currency, should ideally be equal. We looked at the law of one price, arbitrage, absolute PPP, relative PPP, and how inflation differentials drive exchange rate movements. Now, before we move into today's topic, I want you to hold two things from the lecture firmly in your mind. High inflation rate in a country causes its currency to depreciate. When price rise faster in one country than in another, the purchasing power of that country's currency falls. Demand for its goods falls. Demand for its currency falls, and therefore its exchange rate weakens. The second idea is high interest rate in a country causes its currency to appreciate. Let us understand with help of an example. Suppose interest rate in the US rise while interest rates in the UK remain unchanged. American financial assets such as bank deposits, bonds and treasury securities now offer higher returns than similar British assets. For investors, this makes US assets more attractive. A British investor who wants to earn the higher return will move funds from the UK to the US. To do this, they must first sell pounds and buy dollars. As many investors do the same thing, demand for the dollar increases and demand for the pound falls. The higher demand pushes up the value of the dollar, while the pound tends to weaken. What is the result? The US dollar appreciates and the British pound depreciates. So, higher interest rates have strengthened the dollar. And now the combined effect. This is where it really gets deep. Higher US interest rates attract capital from around the world, including from Britain. Money flows into the US, but this very influx of capital can start to generate inflationary pressure within the US economy. More money chasing the same goods and services. So, higher interest rates that initially attracted capital may over time signal and contribute to rising inflation. And rising inflation, as we just discussed, works to weaken the dollar. So, you have two forces: interest rates pulling the dollar up, inflation pulling it down. They are working in opposite direction. The net outcome depends on the magnitude and timing of each. Now, here is a critical question I want you to think about. These two forces, that is, inflation and interest rates, appear to work in opposite directions on a currency. Inflation weakens it, interest rate strengthens it. But in the real world, high inflation and high interest rates often go together. A country experiencing high inflation typically raises its interest rate to control it. So, what is the net effect? What actually happens to the exchange rate when both forces are operating simultaneously? The question is exactly what today's lecture is going to answer. When we bring together the effect of inflation and the effect of interest rates and merge them into a single unified framework, we arrive at international Fisher effect. And within that, we also study the underlying building blocks, the Fisher effect, which explains what a nominal interest rate is really made of. These two theories together form one of the most elegant and important frameworks in international finance. Let us begin. So, let us formally define the international Fisher effect. The International Fisher effect, or IFP, postulates that the interest rate differential between two countries should equal the inflation rate differential between those two countries. That is, the difference in interest rates between country A and country B should be equal to the difference in the expected inflation rate between country A and country B. Now, why should this be true? What is the logic? The rationale is grounded in investor behavior. Think about it from the perspective of a rational investor. If a country is expected to depreciate, say the Indian rupee is expected to lose value relative to the US dollar, would you still want to invest in India? Well, you might, but only if the interest rate offered on the Indian assets is high enough to compensate for the expected loss from currency depreciation. In other words, a higher interest rate is in country is not a free gift to investors. It is a compensation for an expected loss, specifically the loss from the currency depreciation. The high interest rate and currency depreciation cancel each other out, leaving the investor with roughly the same real return as they would have earned at home. Now let us look at the formula. The IFE is expressed as 1 plus interest rate in country A divided by 1 plus interest rate in country B equal to 1 plus inflation rate in A divided by inflation rate in B, where RA and RB are interest rate in country A and B, and IA and IB are expected inflation rates in country A and country B. What this formula says is that the ratio of interest rate between two countries should be equal to the ratio of their expected inflation rates. If country A has a higher inflation rate than country B, country A will also have higher nominal interest rates, and those higher rates will simply reflect the expected depreciation of country A's currency. The real return after adjusting for currency movements will be the same in both countries. Investors compare returns across countries and choose the option that gives them the best overall return. However, they do not look only at the interest rate, they also consider what may happen to the exchange rate. If a currency is expected to depreciate in future, investors know that part of their return may be lost when they convert their money back into their own currency. Therefore, they will invest in that country only if its interest rate is high enough to compensate for the expected loss from currency depreciation. Arbitrage is a force that drives the international Fisher effect. Investors constantly move capital across countries in search of higher returns, but they care about real returns, not just the nominal interest rates. If one country offers a higher interest rate but its currency is expected to depreciate by the same amount, then investors do not gain anything extra in real terms. As investors shift funds towards country offering better opportunities, exchange rates adjust. Over time, these adjustments tend to bring real returns closer together across countries. Of course, this equalization is not perfect or immediate. In the short run, there can be temporary deviations because of capital controls, transaction costs, taxes, political risk, or imperfect information. Even so, the overall tendency is towards equalization of real returns, and that is what makes international Fisher effect such a useful theoretical framework. Now let us understand the international Fisher effect with help of the graph. Now here we have the x-axis and we have the y-axis. In the x-axis we have the change, the percentage change in foreign currency value, and here we have the interest rate. Let us denote it by I here. Interest rate of home, that is domestic, minus interest rate of foreign. Now here we have an IFE line, that is where, which is 45 degrees from here, and we have some points which are E and F here. Exchange rates are adjusting perfectly to offset interest rate differential. That means the if we see that the depreciation and or the appreciation of foreign currency offsets the difference in the interest rate between two countries. Between two countries. So this is our IH minus IF, and this is the percentage change in foreign exchange rate, foreign currency we can say. Here the currency, foreign currency is appreciating, and here it is depreciating. Every point on this line represents a situation where the exchange rate has adjusted perfectly to offset the interest rate differential. If interest rate is 3% higher, the foreign currency has depreciated by exactly 3%. The higher interest earning is completely wiped out by the currency loss. The investor earns the same return whether they invested domestically or abroad. This is the ideal world for IFE. But of course, real life places points of this line. Let us look at what those means. Let us look at the point G. Now here if we see that the foreign currency, if we see this axis and this axis, we will find that the foreign currency has appreciated by 2%. This is the appreciation, and this is the percentage change in the value of foreign currency. Let me write it FC, and this is IH minus IF. Now this G here, there is the home interest, the foreign interest rate is greater than the domestic interest rate. That is why it is in the minus side here, and there is an appreciation of 2% in the foreign currency. Now here means that if we see the combined effect, then the foreign yield is greater than the domestic yield. Investing abroad is more profitable. Now think about this, what it means. For an investor who invested in the foreign country, they earned an extra 3% from the higher interest rate and gained another 2% from the currency appreciation. The combined foreign yield is substantially higher than the domestic yield. This is a situation where investing abroad was clearly more profitable. Now we have another situation, and now this is point H. Now if we see that the home interest rate is, the foreign interest rate also is greater in this aspect, and it is greater by 3%. You see here it is greater by 3%. So our here in this case IF is greater than IH, and at the same time the foreign currency has depreciated by 5%. So here the depreciation has offset the interest rate advantage, and investing abroad is less profitable. At point H, the foreign interest rate is again 3% higher than the home rate. So far so good, but now the foreign currency has depreciated by 5%. The investor earned 3% extra from interest, but lost 5% from currency movement. The net result is a loss compared to investing at home. the interest rate advantage was not just neutralized, it was more than wiped out by depreciation. This point sits above IFE line. Now let us talk about J. So here we have the domestic interest rate is greater than the foreign interest rate. Now foreign currency has also depreciated. Now if we see, the foreign currency has also depreciated here. So there is a double disadvantage. First of all, there is a lower interest rate, and second is that there is a depreciation also. So point J, which is above the IFE line, has a double disadvantage. Point J is the most unfortunate scenario. Here the foreign interest rate is actually lower than the home interest rate. So the investor is already giving up the interest income by going abroad. And on the top of that, the foreign currency is depreciating. During the period the deposit is held, the investor faces two simultaneous losses, a lower interest rate and a weaker currency, a complete double disadvantage. So the IFA line is a powerful visual diagnostic. It tells us at glance whether a foreign investment outperformed, underperformed or matched domestic returns. Let us now make all of this very concrete with a numerical example. I find that exchange rate theory, more than almost any other topic in finance, becomes truly clear when you work through the numbers carefully. So let us do that. Here is a scenario. The interest rate in the United States is 10%. The interest rate in Britain is 8%. The initial exchange rate is 1 British pound equals to 1.20 US dollar, and the British investor decides to invest 100 US dollars in the United States. Now the British investor is thinking, the US interest rate is 2% points higher than back home in Britain. Should I invest here? Now let us understand international Fisher effect with help of the example. Let us do this solution of the question. Now let us say there is a British investor. Now this British investor, he actually is planning to invest $100 in USA because USA is giving a higher rate of interest. Now that at point when he is deciding this, the 1 pound is equal to 1.20 dollar. Now his initial investment, what is going to be his initial investment in pounds? His initial investment in pound is going to be 100 divided by 1.20, which gives him pound 83. Now it means that first he is having pound 83 with him, then he is going to convert it into dollars, and he is going to have how much with him? $100 with him, which he is going to invest in USA at 10%, and this will give him 100 into 1.10. So the total amount that he is going to get while investing in USA is $110. Now this $110 will be eventually converted into pounds. Now what happens is when there is such high interest rate in USA, there is an increased money supply due to capital inflow in USA, which causes dollars to depreciate. Now let us say that the new rate is 1 pound is equal to 1.25 dollars. So we have to convert the gain or the amount he has got in USA to pound. Now to convert it, what we are going to do, we are going to divide 110 by 1.25, and this gives us a value which is pound 88. So that means if he invested $100 and if we consider in terms of pounds, so he invested 83 pounds in USA and he got how much? He got 88 pounds. Now this is his investment. Now let us say if he invested the same amount 83 in his own country, that is UK, at a rate of 8%, what would have been his gain? So it is going to be 83, 1 plus 0.08, this gives us around 89.64 pounds. So that means if he invests in USA, he is going to earn less because dollar has depreciated more than what was the interest rate differential. So it is better that he invest in his own country, that is his own home country. And this is perfectly the message of international Fisher effect. The higher interest rate in the US was not a free gift. It was in fact compensation for the expected depreciation of the dollar. In this example, the compensation was actually insufficient. The depreciation was larger than expected, so the investor ended up worse off. But directionally, the IFE prediction is confirmed. High interest rates and currency depreciation go hand in hand, and the net effect on foreign investors tends towards the same result as investing domestically. This is a fundamental insight. When you see a country offering high interest rate, do not immediately assume it is a good investment opportunity. Ask yourself, why is the interest rate so high? In many cases, the answer is because the currency is expected to depreciate. The high rate is the market's way of compensating you for that risk. Now, the international Fisher effect gave us a relationship between nominal interest rate across countries and the exchange rates. But I want to know now take one step deeper and ask a more fundamental question. What exactly is nominal interest rate? What does it consist of? When you see a bank advertisement saying fixed deposit at 10% per annum, what does that 10% really mean? Does it mean your real wealth grows by 10%? Does it mean your purchasing power increases by 10%? The answer, as you might suspect, is not necessarily. And the reason is inflation. The international Fisher effect explains how differences in interest rate and inflation across countries influence exchange rates. But within a single country, what is the relationship between inflation and nominal interest rate? This is explained by Fisher effect. This is where the Fisher effect comes in, named after the great American economist. The Fisher effect is domestic single country version of what the IFE does across countries, and it is the theoretical building block that underpins the IFE. Let us explore it carefully. Let us start with a simple example that makes the problem very clear. Suppose you deposit $1 in bank today at a nominal interest rate of 10%. After 1 year, the bank gives you back $1.10. But here is the question. Can you buy more goods and services with $1.10 next year than you could with $1 today? The value of money changes as prices rise or fall. What matters to the investor is not how much money they hold in numerical terms, but how much purchasing power that money gives them in terms of goods and services. Purchasing power depends entirely on inflation. If prices have risen, if the same basket of goods that cost $1 today cost $1.10 next year, then your $1.10 buys exactly the same amount as your $1 did before. Your purchasing power has not increased at all. Your real return is zero. Now make it slightly worse. Suppose inflation is 12%, prices have risen to 12%, but your deposit only grew by 10%. You are actually poorer in real terms. You can buy less with $1.10 next year than you could do with $1 today. This is the fundamental insight that Fisher gave us. Nominal interest rate are rates we see in the which are advertised. They are the rates commonly encountered in everyday financial dealing. But what matters to the investor is that what truly determines whether an investment is worthwhile. It is not how much dollars, pounds, or rupees they hold at the end of the year. It is what those dollars, pounds, or rupees can actually buy. It is the real return, the return in terms of purchasing power. To address this problem systematically, Fisher decomposed the nominal interest rate into two distinct components. The first component is the real interest rate, the return that actually reflects genuine growth and purchasing power after stripping out inflation. The second component is the expected rate of inflation, the compensation the lender requires simply to maintain the purchasing power of the principal and interest against rising prices. The decomposition is what we call the Fisher effect. The formula is 1 plus R is equal to 1 plus alpha into 1 plus I, where R is the nominal interest rate, what you see advertised, and alpha is the real interest rate, the genuine return. I is the expected inflation rate. What this formula says is the nominal interest rate is not just one thing. It is the product of the real rate and the inflation adjustment. Let us verify with our numbers. So let me explain you with the help of an example. We have nominal interest rate as 10% and an inflation rate as 4%. So if we have to calculate real interest rate, then this is equal to be 1 plus R upon 1 plus I minus 1. So this comes out to be 1 plus 0.1 upon 1 plus 0.04 minus 1. This gives us the value 5.77%. So what is our real interest rate? Our real interest rate is 5.77% while the nominal is 10%. Now what does this tell us? It tells us that even though the nominal rate appears to be 10%, the investor's purchasing power, the ability to buy real goods and services, is only growing by 5.77% per year. The remaining approximately 4.23% of the nominal return is simply offsetting inflation. It is not real gain, it is an illusion of gain. This is profoundly important insights for investors, particularly in international finance. When comparing investment opportunities across countries, you should never simply compare nominal interest rate. A country offering 15% nominal interest rate may be offering a far lower real return than a country offering 6% nominal interest rate. If the first country has 12% inflation and the second country has only 1% inflation, the nominal rate is the headline, the real rate is the truth. Now, the Fisher effect has a very important implication for international capital flows, and this is where it connects back to the international Fisher effect we studied earlier. The concept of real interest rate is applicable not just to the domestic investments but to all investment domains, including investments in foreign currencies. Here is what it means in practice. Suppose a real interest rate in India is 6%, while the real interest rate in USA is 3%. A favorable differential in real interest rate has emerged. What rational investors or arbitrators do? They will move capital from the US to India, seeking the higher real return. This flow of international capital will continue as more capital enters in India. It pushes up prices and reduces the real return available. As capital leaves the US real return gradually rises. This process continues until real interest rate equalizes across the two countries. This is an equilibrium condition. In the world of free capital movement and rational investors, real interest rates cannot remain persistently different across countries. Arbitrage enforces convergence. Now you can see how beautifully this connects to IFE. The IFE says that nominal interest rate differentials equals to inflation differentials. The Fisher effect says nominal rates is equal to real rates plus inflation. Put these two together and the implication is in equilibrium, real interest rates are equal across countries. High nominal rates in one country simply reflect high inflation, not genuinely higher real returns. This is the unified picture. Let us close today's lecture by pulling together all the key ideas. We begin with the question: what happens to exchange rate when both inflation and interest rates are operating simultaneously? The answer we found is the international Fisher effect. Higher interest rate in a country are simply compensation for expected currency depreciation. In equilibrium, the interest rate differential between two countries equals to the inflation rate differentials, and investors earn the same real return regardless of where they invest. Then we went deeper with Fisher effect. Fisher showed us that the nominal interest rate are not what they appear to be. They are composed of two parts, the real interest rate and the expected inflation rate. What matters to investors is the real rate, the actual growth in the purchasing power. And in the world of free capital movement, real interest rates tend to converge across countries through arbitrage. So, thank you for your attention, and I look forward to seeing you in the next lecture.